All right. Good morning, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for Sunday, November 5th. The sound you hear is the Chiefs playing the Miami Dolphins over in Wembley Stadium. Looks like we got off to an early lead, so that's the sound of freedom and victory in the background. So let's just jump right into the itemized questions. Damien asked, we're having some questions regarding the 30-minute chart, when to enter the trade. Do we enter when the PSAR flips, or do we enter when the PSAR is in several minutes? Please clarify. I'm just going to make it as simple as I can. When price crosses the PSAR, enter. Whenever that happens within the life cycle of price and the bar, enter when price hits it. I say PSAR or PSAR minus one because there naturally is one finesse on this. That's probably a bigger deal on the 3-minute chart, but not really on the 30-minute chart. And the reason is that the amount of in-bar volatility is actually more on the 3-day or on the 3-minute bar than there is on the 30-minute. And here's why I say that. On the 3-minute bars, you could definitely see something where you have a nice, you could have a 30 minutes where nothing is happening. You got 10 bars in there, and not very much has happened at all. And then all of a sudden, some guy comes in with a bag of money to buy it, and then you get 1, 2, 3, and away. And then, if that was a large enough move, that might attract more bags of money to come in and start hitting momentum signals, for machine algorithms that are buying breakouts. And then it may or may not follow through until we run out of new money coming in, and then it starts to stall. So you could go from very, very quiet to an extraordinary move right away. And that might be all that there is, the first 2 or 3 bars. And the size of those 3 bars could be very large compared to the size of what your MMRB might be. And depending on, where the PSAR is tracking to, we have to make some quick decisions in there about, well, price is moving out, and the RL10 is normally very close to price, but during the moment of the breakout for those first 2 or 3 bars, mathematically there's going to be a little bit of a lag. There has to be. It catches up very fast. Like, it catches up a lot faster than the Dragon does, and obviously a lot faster than the Bollinger Band mean, the SMA 30. But in the moment of decision, there can be a separation. So what should we do? Should we wait for the PSAR to flip, from here to here? Should we wait for the RL10 to break above the PSAR? If we do, we run the risk of being 2 or 3 bars behind the actual price. Now, you will see that kind of an anomaly a lot more frequently on a 3-minute chart than you would on a 30-minute chart. On a 30-minute chart, you might see 2 or 3 of those little events where it spiked and then it comes back, and then it spikes again and it comes back. But inside the larger context of the 30-minute bar, it's all just kind of one bar. And because of math, the PSAR break for that thing is going to be a little bit farther away. And the width of the PSAR box is going to be larger on a 30-minute bar than there is on a 3-minute bar. So there's a lot more slack, a lot more wiggle room on the size of the box and the size of the follow through, which could take 60, 90, 120 minutes to unfold on a really strong trend on a 30-minute bar. So it actually is less critical, to fine tune your entry on the 30-minute bar. Like, as long as you're getting in approximately in this region, you're going to be fine, because the amount of variation inside here is small compared to the size of the wrist box. On a 3-minute bar, that's not true, because the wrist box is usually relatively small compared to the amount of 1 bar variation when it surprisingly just goes. So you're going to see that phenomenon quite a bit. So on the 3-minute bar, one of the finesses that we had was that you typically had a dragon right here, and the RL10 would have crossed and then is getting ready to cross it again, right? And the price action that caused that to move might look like this. So the RL10 doesn't cross the dragon until here. It doesn't flip the PSAR until here. And then this bar, whatever bar that bar might be up there. When that bar closes, then the PSAR flips. So that means as soon as this bar closes and the PSAR flips, the next bar is starting, and what's it going to do? Which way is it going? I don't know. But it's probably already past the point where price intersected the descending PSAR. And it's quite often this first move out of the dragon that is the big initial move that's responding to some pile of cash that came in. So we've made 2 adjustments to that. One of them is when we changed the PSAR from 0.2 and 0.12 to 0.2 and 0.14, it turns out that on harsh winter moves, that is enough that the PSAR, by the time this thing turns, is usually down right here, co-located with the upper skin of the dragon. So we removed one of the points of tension. Do I enter when it crosses the dragon, or do I enter when it crosses the PSAR? Well, by bringing those 2 things together with this new, the new reading on that, the PSAR and the upper skin of the dragon in a harsh winter are normally, usually, always at the same location. So now the question is, do I enter it when price crosses the dragon, or when it crosses the PSAR? In this case, because the PSAR is there, it's the same question. So do I enter it when price crosses the PSAR, or do I wait for the RL10, which is the price, we say? Do I wait for that event to occur? When you have a slow turning, grinding price that looks like this, it's normally not an issue, because when that happens, the RL10 has turned and is now co-located with the price anyway. And when the PSAR comes down, that all happens at the same time. It usually happens right at the edge right at the edge of the dragon, so it's very, very easy when there is orderly price. The only issue is ever occurs when you have a surprise rocket ship kind of a move and it blasts through there, right? So the first adjustment we made was to bring the PSAR down to the edge of the dragon by making the acceleration factor 0.14, which means that it comes down and joins the dragon. The second thing that I've done in the past is that when the PSAR is coming down, and I was mindful of this moment. So this is the live bar that we're in right here. Let me show you that in orange, I guess. No, in blue. So the live bar is right here, right? That's the time period that is live. The last time the PSAR printed was here, because that's where price closed, then the PSAR was printed, and now it has opened and up price is going. When this bar closes, it might have, and the RL10 may have been here. When the RL10 goes through the PSAR, then we could enter. So we're already 1 or 2 time periods past the point where the price was coming into the PSAR. So all we did in the past was we just said, look, when this bar was active, we went back -1 or -2 bars and just drew a line across. And whenever price went through that, we took it. And the idea was that if you had an accelerated price bar, you could still get in before the PSAR flipped, and then you would make sure that you were in on runaway moves. And it took a runaway move to be able to get into that previous PSAR. And we were either -1 or -2. Now, when we move the PSAR down to 0.14, this is close enough to the dragon that is less of an issue. And I would just say right now, on the 30-minute bars, just when the price hits the PSAR, trigger an entry and just get in, because that's the least important one anyway. And remember that the larger your execution box is, the difference in whether you get in here or here or here is not as important because the box is so large. If this was a really small box, like you might see on a 3-minute bar, then that difference could be significant. But if you've got a large wrist box and you think this thing is going to go 1 or 2 of those wrist boxes, it turns out that difference is not that significant. Just hold your nose and get in. And so to keep it absolutely simple, just get in when it price crosses the PSAR on 30-minute bars. Just get in. Now, the reason I want to highlight this question, do we enter when the PSAR is in several minutes? No. Because this is what will happen. You have a clear rule. You get in. Right at that moment, no other moment, you just get in. Problem solved. But if you have this kind of a rule that says, well, let me just wait and see what's going on. Yeah, the PSAR flipped. Now let me just think about it. Let me just look at it for a couple minutes, and then I'll decide if I'm going to get in or not. That's not a rule at all. All that is cognitive load. That is some mysterious, magical thinking that's undefined. And now at the moment of decision, when it should be just easy to pull the trigger, you're starting to think about it. And what criteria you're going to use this time? What did I use last time? What's my rule? I don't have a rule. So don't even go down that pathway, because you would then have to say, I'd have to itemize, hey, I'm 1 minute in, 2 minutes in. I'm on the 30-minute chart. Am I going to drop down to a new time frame to make that judgment? Or am I going to watch one bar and watching the actual price flutter like a serpent's tongue in and out as it's just bouncing around in the middle of that bar? And just watch that for 30 minutes and then suddenly make a decision, oh, that was enough, I'm just going to get in. That's the opposite of rule-based. You're setting yourself up for second guessing, extra thinking. How do I feel? What could be going on? You're letting the chimpanzee drive. So, under no circumstances should you answer that question like that. On this question or all future ones, turn it into a rule and then study the rule. When you have 500 trades, and I'm exaggerating for effect, but not really, when you have 500 trades on a rule set, now you can start thinking about, well, under this circumstance, I'm going to use some trader's judgment to change one rule to get in or to get out. I'm going to wait a little bit longer, or I'm going to go now just before the criteria hits that it looks like it's going to hit. I'm going to front run, or I'm going to delay. After you have 500 trades in and you've mastered that rule set and you've done all the work in your trade log to render it into a histogram, and you've studied the sustains and improves and action steps, and you've seen the results of what might happen, then you can vary one thing and change the rule set using your judgment at prototype level of risk, and then record the results of when you use that new circumstance. And then what you do is you compute what would have happened if you just followed the rules, and then you compute what happened when you change that rule, and then when you've done that 30 times, changing it in one way, and then you compare the difference between that modification and the original rule set, you can then decide if your trader judgment added value or lost value. That's your trader quality number. You had some kind of intuition that, based on experience, you think this modification of the rules might work. So you try it and you get the results. But you got to compare it against the base case to determine if that judgment actually paid off. And you got to do that 30 times so that you have a statistically significant set of data to determine if your trader's judgment actually adds value. And the change that you made each of those 30 times has to be the same change. Otherwise, you're comparing apples and oranges. That's if you're going to use the industrial manufacturing approach to quality management. You must have a system that is under control, meaning that the variation in performance caused by you is small, and you see now how that system and the rules operate in the market under a lot of different conditions, and then you get these kinds of results. But the system is under control. Then you can change one variable and then see how that changes the performance of the results, independent of you. The way you want to do it is this. What you want to say is, oh, I've got this set of guidelines, which I used to call rules because I followed them ruthlessly. Now I'm going to allow myself to add some discretion, and then how I add discretion is going to vary on each and every trade. Sometimes I get triggered by what the market is doing. Other times I get triggered by the time of day. A third time I get triggered by the heartburn I had because I had hot sauce for lunch. So I end up taking an ironclad set of rules and I turn it into a set of guidelines that covers about 80% of my behavior. And about 20% of my behavior are these things where I'm varying it in all different kinds of directions. And then I have a whole set of new results. But no single case study is like any of the other ones. So it's a set of 30 one-off situations, not statistically significant in terms of the specific rule, but what it does let you say is, well, if in the future I keep responding almost randomly to these other stimuli, then it seems like when I do that, I'm either adding or subtracting value. Now, unless you sit down and document like you did before what the results of the baseline are, all you'll remember are the ones where it worked. And you'll say, oh, my trader quality number is excellent because I only remember the ones where it worked. That's, hindsight bias or some anchoring bias, or it's lying to yourself is what it is. It's the gambler's fallacy. So if you're gonna trust your total your trader quality number, the trader quality number is the difference between what the robot gets plus you. Whenever you start varying the rules and turn them into guidelines, whatever the net difference is, that's what your trader quality number is. Now, I'm not saying it does not exist. I'm saying there's a lot of guys who, for long periods of time, have a feel for the market that they can't even fully describe until after the decision is made. And then you wonder, is that really what triggered the decision, or is that what they wish triggered the decision because they're trying to explain it to somebody to make themselves feel smart? Or maybe they're doing their best and they're just not aware of what actually triggered them. There's a whole lot of things that go on into that. I've spent 30 years of trying to write rules that document my inner state when I'm trading. That's why the PSAR is what the PSAR is because I was using trader judgment on where to place my exit. And then when I had 500 trades that I really liked, and I liked the way I traded off letting it run versus cashing the trade, I tracked how I was adjusting that stop in some kind of regular manner. And then I simply took the PSAR and I started, this one is too wide, so let me accelerate it a little more. Oh, not too much. And then I came up with a set of arbitrary dots that closely approximated the way most of my good trade exit management processes were. And then I had a tentative set of symbols or of parameters on the PSAR. And then when I figured out that, when you make that the RL10 is the price, that's really good. That's really close to what I want. Now I have a objective indicator that tells me where the accumulated experience of my trading career suggests that wherever that PSAR is, that's probably a pretty good place to have the stop right now. And if your stop is lower than that, Ken, you better have a darn good reason why. Oh, and you don't. And if it's higher than that, it's probably because you're afraid of giving back a large move, and maybe you just need a rule. How big does that move have to be before you feel like accelerating the PSAR? In what rule? Oh, here's my rule. After 2R, hang a MMRB from the top. Done. Now I have a rule. And I can program that. And I can study the performance over a large data set. And now I have turned my intuition, which could very well be based on facts and evidence and deep order that my conscious brain can't even see. But it seemed when I acted on those things under controlled conditions, it seems like I had a positive TQN in that circumstance. So let me turn the intuition into a rule. And now I've offloaded all of the effort from my gut and my brain to a robot. So this question, do we enter when the PSAR flips? That's a rule. Do we enter when the PSAR is in several minutes? That's an intuition because that's fuzzy. What do you mean several minutes? And it begs so many questions. See earlier discussion. So I would just tell you, on the 30-minute chart, because the variation in price is little, it's a big snake, and the head with the tiny little fluttering tongue is small compared to the size of the moves that it's going to make. Just trigger on the PSAR. And that means you could be stalking that thing an hour or 2 hours ahead of time. Because you see this thing, the PSAR's coming down, and the dragon's coming down, and the dragon's just getting ready to turn. And this thing had a harsh winter. And there's a 1, 2, 3 entry. And you can see that we are we're about 90 minutes away from an orderly reversal where this thing is going to enter. So you could just right now say, on this bar, I'm gonna get in if it goes through that line. And then for the next 30 minutes, as this thing is progressing to the next bar, if it ever has a spike because somebody came in with a bag of money, you're in. Oh, but it didn't spike. It just continued to grind. Okay, so now the bar is here and the PSAR is there. There's my line. I'm done thinking. I can go look at, I can make that an entry or an alert. If it's an entry, it triggers without my intervention. If it's an alert, it says, hey, come look at the chart. Push the button or don't push the button. I would rather just make it an entry and then go try to get out of trouble. Because if I just make it an alert, I'm going to come and now I'm going to start looking at it. I'm going to start thinking. If my plan is just come here and said, there's no obvious reason to veto it, then I'm in. What's the only thing that would make me veto that? Oh, maybe there was a misprint in the order book and the thing went up here and it filled and now it comes back and it's now, and when I get there seconds later, it's under the PSAR. Like there was one bad, weird print that caused the rule to fire. Oh, okay. So that's a reason you might, but you got to decide that's what I'm going to do if I get the alert. Unless I see some kind of weird price anomaly where it is way far above, I'm just going to hit enter and go. I spent more time than you might have expected on what is really a simple answer because there is a hidden trap in that thing that has to do with that phrase. That is the lure of the chimpanzee to overly complexify. Notice that what I did was have a deep understanding of the difference between a 3-minute bar and a 30-minute bar, and how I adjusted a rule so that instead of the PSAR being well above the dragon typically, that after a harsh winter, we've adjusted the PSAR so now the extra acceleration factor brings it down to the edge of the dragon and simplified my life. And then I've given you a tactic which says eliminate thinking about it early and just say, once you see the stock, what's the signal to stock it and put the order on? That? What's that? Oh, that's the sharp point that the RL10 comes to when it reverses, which is one of the features of the RL10. It makes sharp corners. When that slope goes from down to up, that can only be because the price action rolled over enough to make that occur. It takes 2 to 3 bars of a reversal in price action to cause the RL10 to change. And in a harsh winter, by definition, you're going to be well away from the dragon, and the PSAR will be on the far side of the dragon. So from the time that that little flip occurred to the time when you're going to enter, you're typically going to have 1 to 5 bars of time before that occurs, which means you have plenty of time to come and start making the cascading order entries. And I say 1 bar because this could be the bar that just does that. Boom, I'm in. What would cause it to do that? A great big large pile of money that is responding to what in retrospect looks like the massively overreacted, fearful move away from fair value. And this is guys that were gaming the system. Maybe this was low volume and this is high volume. They set a trap for all the guys that were short, or whatever. They were just running the stops, and now they're coming in with massive size. And that's triggering a buying campaign on large volume. I don't want to go through all the reasons why it's a great big spiky bar. There's more reasons than you could even imagine. And then what are you going to try to classify your decision based on what you think is the reason that's causing the big spike in price? Really? You're going to reverse engineer that? No. Just put an entry on it, get in, and then get your risk out, and then it's academic. So just do that. Rajiv asked, I have been studying the price actions of Kata 2 in relation to the Red River. So he's studying the Kata 2 pattern, which means that there was a successful trade in the SSC or a previous Kata 2. There was a successful trade that caused us to get out. It probably crossed the dragon, and now the RL10 crosses the dragon again, making a higher low compared to the last one. So those are the 2 things that it takes to establish a Kata 2. A successful trade, a higher low, and now the RL10 is moving in the same direction as the primary previous trend. And it's a Kata 2 if I enter in the pocket before it takes out the previous peak of the RL10, it's a Kata 2 if it's in here. If I wait for it to break above the previous peak of the RL10, then it's an emerging dragon. In the best of all possible worlds, this retracement distance is so small that those two entries are very close. That's the best of all possible worlds because you had a really strong move up. You had the minimal amount of pullback, just enough to get you out, and then it reverses right away. And the pocket is very small, and so you just kind of enter wherever you get filled. In other cases, that successful trade might meander for a while and then crosses after the dragon has well rolled over. And then there's a clear distinction between where the Kata 2 enters and where the emerging dragon enters. So that can be the case. And that's going to be driven by the amount of time between those two peaks and the magnitude of the move. Will tell you in my view, I would love to get right back in, even though your conventional wisdom, your inner voice will tell you, oh, you should never have gotten out, see, because it that was just a hiccup, and you see it just kept going. So you should have saved the dollar of commission, and you should have just kept that as open risk, because you should have known that it was going to reverse right away. Really? No, you don't. You have no idea how long this thing is going to go before it reverses. And then if you don't take that, every time it goes down, you just say, "Well, surely it's going to reverse now, so I'll just stay one more time." And now you've blown up your rules, and you've ended up giving back how much from the maximum favorable excursion. So make your exit a rule base and make your re-entry a rule base. And then it doesn't matter how much time, because you can just blame the rule. So he's looking at the Kata 2, and here are some of his observations. When the MACD signal line is above the Red River, now what he's doing is comparing in the price window the Kata 2s, and he's comparing that to the MACD window, in which he notices the zero line, and he's noticing the signal line, and he's noticing the Red River, which is a 30-period Bollinger Band, plus or minus 1, on the MACD signal line itself. This window, the MACD window, is a simplified version of what's going on with the 10 versus the 30-period moving average. It turns out that the difference in MACD, if you're using the RLs versus the simple moving average, it doesn't really change that relationship much, because it's already smoothed, and you're comparing the distance between two lines, and the rate of change between the pairs is relatively equal. So it actually doesn't matter that much which one you use. What matters is that the MACD is a simplified version of what's going on in price, and is often a very rapid way of capturing what is going on in price without the extra noise, which is why we like two things about the MACD window. There's two things that are good. One of them is the Four Seasons, and one of them is the MACD line relative to the Red River. The seasonality tells you based on the zero line, and if this is the signal line, you can see the very smooth oscillation of the signal line and determine what the mood of the market is using an analogy of weather. So if it's above the zero line, then that is summer. And that's good for crops to grow. And then when it breaks the 12 o'clock position and it is above the zero line, but with negative slope, it is in the fall. And in the fall, you are concerned with two things. Make sure I'm out before this thing becomes the winter and preserve the profit, but also be ready at any time for this thing to become a second summer, what the farmers here would call the Indian summer, because summer, fall, summer is an automatic reentry instantly. Summer, fall, summer is an automatic reentry. And you get that when you see Kata 2s. Because instead of failing further, it reverses and goes higher. This causes a summer, fall, summer when this is a big move. You would like for it to be the smallest fall season of all and a rapid resumption of the summer. You would love to see that. But as long as it goes summer, fall, summer, you like that. In the same way, an even better signal is when the MACD line goes below the zero line, and now it is descending in slope. That is always a time to be short. Massive goodness. My favorite time to trade on the short side. And then when it cannot fail any further and things are slowly getting better, you will see it begin to slope up. And I would have made that orange if I had realized how crappy yellow looks like on a white background. But I sort of was committed to that. So the spring turns out to be a really good time to plant seeds carefully that are then going to harvest in case this summer really goes. Then those entries, which were dangerous in the spring, those turn out to be great. Just because it starts in the summer doesn't mean it's going to be a brilliant summer. This thing could roll over and become one of these. In which case, you want to be so short that you can't stand it. Because you had a massive winter. Everybody that made money in the spring made their money, and nobody showed up to push the summer higher. So that means there's a good chance that second winter is coming. So this is what I like about the seasonality. The final one is, I will say, in the same way that summer, fall, summer is good, winter, spring, winter is an auto reentry short, because you're going to see collapsing dragons galore on that one. Just go. So this really gives you very simplified, reliable view of what's going on in the complex world of individual bars and dragons, and the river if you have that painted on there. This is a really simplified way of doing that. So if the first thing I like about the MACD is the four seasons, the second thing I like about it is the Red River. Because this is going to give you a snapshot of the size of the move that just got your attention. So we have the 0 line, and we have the MACD signal line. We then put a Bollinger Band 30 and 1 on the signal line. And what that does is create a band of normal that when it's near the signal line, or when it's near the 0 line and sideways, it's very, very narrow, which it is quite often, because in the price window up there, you'd see a sideways quiet channel happening. That causes the 10 period simple moving average, the dragon, and the river to be very close to each other. And the difference between them is so small that the red river, which tracks the difference between them, is also very small. And then something will happen where price shoots out of the river, followed closely by the RL10, followed more slowly by the 30 period moving average. And in that sustained difference between those two moving averages, whether that's the regression line or the simple moving average, that causes the MACD line to rapidly change. And over the course of 3 to 5 bars, that sudden difference between those two causes this to leave the normal, and you get a breakout from the red river. And then the red river slowly adapts to that and creates the new boundary of normal. And as long as that MACD line is above the red river, we're allowed to say that that is an exceptional move. That move is still exceptional to the upside. When that difference can no longer sustain and it starts narrowing as it does up in here, then the MACD line comes back into the red river. And the three things that I check are entered the red river, hits the spine, and then leaves the red river. And now this is in the fall, but it's outside of the red river. This might be the opportunity. There's two opportunities here. If price is just going to collapse, then somewhere in here, you're not going to see Kata 2s working, and you're going to see failure trades working, supported fall crossings, and then that thing's going to go into the winter, and that's going to become a harsh winter because it is outside, it's in the winter, and it's completely outside of the Red River. That is a harsh winter. If this was just a tiny little move into the summer and then got back into the winter, it might be in the winter, but still inside the Red River. That's not as harsh as a harsh winter that's outside of the Red River. So the relationship of the Red River to the MACD signal line tells you something about the size and magnitude of the move that's happening up there. A final way to look at that is the Red River is the z-score of the MACD line compared to the standard deviation that created the Red River. So remember that what looks like a flowing snake is really just a series of thin sliced bars, and then the charting program paints it together. But at any given time, the spine of the Red River is 0. That's +1 and that's -1. So if this starts turning and now becomes the spring of MACD, and it's well outside the Red River, that could be a really brilliant move in the spring, because maybe this was an overreaction. So the bigger the distance from the MACD line to the Red River, the more I like it, because the more extreme it is. Because the Red River is the very definition of normal. At the same time, I know that if this move in the spring ever fails, then I have a winter, spring, winter, and I want to pile on that one because I already have the energy of a harsh winter bringing the sharks back in for another round of murder. So, the 4 seasons of MACD gives me a feel for the routine cycling of price and the psychology that's in play. Guys that plant early, guys that wait, guys that harvest early, guys that try to hang on to the harvest well into the... So you see the full range of a farmer's thinking in the agriculture of the... Out here in Kansas all the time, you see, man, the farmers are planting and it feels like it's cold. Yeah, because they know something about the seasons. And they're harvesting when it's beautiful. Why are they? Because they know something about their crops. So the seasonality of MACD is how you handle all of the routine oscillating of price. The Red River is the snapshot that lets you see the magnitude of the current situation and determining if this is a special case that I really want to pay attention to. So when I see a special case like this, where I have a very harsh winter that is far away from a Red River, I know that this was genuinely a harsh winter that's a critical state that I really want to be good in. And if I'm watching that on 30-minute bars, that's a really good candidate to drop down at the 3-minute bar, because there is a potential change in state that's going to catch people by surprise. That is a big idea. Really big idea. Especially, you might be a guy like me that has 30 symbols on his 30-minute chart, and I'm trying to figure out which 3 do I want to drop down and look at on the 3 minutes. So I got to have a way to stalk those rapidly. How can I do that? Well, I can make the price window very small because it's noise. And I can just look at the Red River and the MACD and get a rapid feel for that. In fact, I could maximize those 30 charts and just see the flowing of the Red River and the MACD and have an instant appreciation for what's going on. I know which ones, I need to concentrate on that one and bring those into the 3-minute and now maximize price and get ready to fine tune. That's a technique. You have to be able to master a couple different time frames, and you have to be concerned about your span of control for the wide angle lens and your span of control for the tactical lens. I mean, what else were you going to do with your time except develop those skills anyway? You want to do that. That's where you can end up heading with that. So, the Red River is the normal relationship between fast and slow MAs. When price is relatively sideways, the Red River is thin and sideways near the zero line. When there's been an extreme move, the MACD line is outside of the Red River, and this is significant. The slope of the MACD line is significant as it defines the season of MACD. I treat the outer skin and the spine of the Red River as indicators so that I can see where the life cycle of this thing is. So when the MACD line is doing that, it was in the winter and now it's in the spring. At some point, that rascal is going to hit the Red River, and I can see it crossed from winter into spring, and now there was enough that it's just crossing normal. And if it gets all the way through there, it's going to be abnormal, and that's going to be good because that's going to be an amazing spring. So when I'm ready to play that one, I like to give it that much room in the spring, but right around here or in here, I should be able to enter on the price window up north. And so that just gives me like, here's a checkpoint where winter became spring, and then the MACD line entered the Red River, crossed the spine, exited, and then at some point there's the zero line up here where it's going to go from spring into summer. So there's like 5 road signs, 5 rungs on the ladder as it moves up the stack. Guess what else does exactly that picture? The RL10, when it crosses the dragon and crosses the dragon again. It's the same interpretation, only in the MACD window I'm using the MACD line and the Red River, but it's the same principle that the slope of the RL10 was negative and now went positive. Oh, remember, that's a sharp point, right? That's a sharp point, and that's where the PSAR is going to flip to later. And then when it enters the dragon, crosses the spine, and exits the dragon, if we've done our work right, that's going to be very close to where the PSAR was flipping. And on the price window, that's where I like to enter. On the MACD line, because of math, this is where I should be stalking that entry. Because by the time this has happened, the SSC has happened. This may be a kata 2 when I go up and look at price. Joe asked, Joe noticed an evolution in the harsh winter definition between 3 frog boxes and 3 R10. If I said that, which I don't think I did, then I shouldn't have said that because that's not true. What I said earlier is true. 1.5 frog boxes from the open, 1.5 frog boxes is an unambiguous harsh winter intraday. Unambiguous. Now, what's even better is if it closed here and then gapped down to here and then sold off another 1.5. Boy, that is a harsh winter all day. You can see that for forever. Or in the MACD window, the signal line is clearly in the winter, meaning it's below the zero line, and it is out of the Red River. That creates a harsh winter. It's not unusual to see both of those happen. But you could get this with a bad gap and then a couple bars of negative follow through. This one is really geared towards the open. This one can occur anytime during the day, like at lunchtime. I mean, it could have gone up and then at lunchtime settled into 90 minutes of this. And then you end up getting a really, really tight red river right around the zero line that's oscillating between summer, fall, winter, spring, summer, fall, winter, spring. And you look at that and you say, oh, that's what's going on right here. So we don't trade the early piece because that's just sideways quiet channel. But this one after 90 minutes could be a Z3 pinch because it's one frog box. The Z3 lines are inside a frog box, and you would see a really tightly compressed red river, and then you get one massive move, and then off we go. And you're going to see that become a harsh winter fast. But the reason you're into that is because you might have just straddled the middle of the river with a frog box, so you end up having half a frog box in either direction, and that's actually pretty close to an MMRB, believe it or not. Because typically, the R10, it's not unusual to see that 3 times the R10 equals one frog box. That's not how we compute it, but it's not unusual to see that. Because remember, mathematically, the range stat is the average range of the last 30 days plus a standard deviation. The frog box is the standard deviation of the range of the last 30 days. So this can vary. The R10 is 1/10 of the range stat. And the frog quality number is the average range divided by the standard deviation. And the standard deviation is the frog box. So the frog quality number simply says, if this was the average range of the last 30 days, and today's standard deviation was this much, there could be, in a typical thing, there could be 4, which gives you an FQN of 4, and that's extremely rare. And the standard deviation could have been so big that it could have been just 2. So the frog box changes quite a bit, but the range stat, which is the average plus 1 standard deviation, either this one or that one, when you divide that into 10 segments, you get the R10. So it's a little bit of circular logic. There's a little bit of math, but it's an accident if the R10 is exactly 1/3 of the frog box. It could happen. It happens if your frog quality number was exactly 3. You could see that, but this is normally what it is, but it's plus or minus 1 or 2, right? So it's usually 2 to 4 R10s will get you to a frog box. I say all that just to confuse something that's probably should just be simple. The harsh winter on the intraday trade. You know, the 1.5 frog box has no meaning outside of the intraday. Like in swing trading and core, irrelevant. There, I would use 2 ATRs from BB mean. Because you had some Bollinger Band mean here, and now all of a sudden you had a 2 ATR move Now I have a sudden sharp move that negates all that previous stuff. That looks significant. And now that sets up wherever price was. That now sets up a compound critical state that's ready to break out. Like this hopefully is a doji. That's either going to be a reversal back to the 10-day high or whatever that reasonable value is, or it's going to be a second leg down. The fact that this was an abnormally large move tells us that it's in play. So intraday, what we need is 1.5 frog boxes. Externally, I need this. It turns out that the MACD definition is good on every time frame because that will trigger when there's an abnormal move. So that's actually the best way to define a harsh winter. But if you got to put a quantity on it, intraday, swing trading. On this one, I would just say, look, the nightly podcast review of my hybrid trades and the stuff, that is a typical day of trading for me. And the markups I'm doing on the charts are my trading journal. And the commentary that I'm making about my judgment or lack of it or the insights is the way I'm verbally taking notes of what to look for. In the chat room, there's a ton of trade logs and histograms. And if you go look at the on tortoisecapital.net, the annual research presentation from the traders, all of those guys have their histograms. That's how to use it, and you'll hear me commenting on it. That's the best example of it. That's the annual presentations from the research weekend. What I'm going to do is give you guys the live trading Kansas City, I think it's 2019. I have been selling that for $4.97, and that has about 200 trade case studies from a live all-day trading workshop with traders and me in Kansas City, filming it with commentary and screenshots of all the critical and all that shit stuff. And then the after action review, the closeout at the end of the day to review the bidding. So you can zoom in and take a look at the intraday. Now, you're not going to see the exact names of things like supported spring crossing, but you're going to see WMB3. You're going to see they're kind of the same patterns. It's the same framework on the charts and the commentary and the and how we're doing the live and dynamic trade framing, anticipating where those turning points are going to be and putting the orders in and what's going to trigger, and then the record keep. You'll see all that stuff. So I'm going to make that available to you, and then you can study that to your heart's content. Like there's not enough videos for you to look at in Foundations. There's another 100 hours of live trading in there, and that's probably the best thing because there's no kind of dead time in there. It just goes from case study to case study. So that'll get you moving. Okay. All right, that's everything I have for from this one. I did want to share. I shared a flashcard with you, which is this one. I'll be adding this one to the Foundations. So if I looked at day trading, what we're doing with day trading, nice trade, swing trading, and core. You can see I got 2 hours of sleep last night and got up early because of the stupid daylight savings time. That's how tuned into this thing I am. I get up without the alarm on 2 hours sleep for fear of missing the meeting. Anyway, in day trading, I give you an introduction to the frog and the Foundations, the details of slow, quick, and leapfrog, which is generation 1, and then hybrid frogage, which is what I'm doing now. That's in the advanced corner. The foundations gives you some insights into visual box trading. You've seen me do some WMB3 lately. The OR3 is prime time goodness for me. The RLFF was generation 1 and generation 2. You see me emphasizing these three in foundations. I really just use generation 1 for information and communication. Like, hey, we're at a P1. That turns out to be the second criteria of the SSC. So we used to trade that, but it failed enough that we realized, oh, we got to have a collapsing dragon anyway. But we could afford to wait for the RL10 and the price to get across the dragon before we entered it. That's the SSC. And you can even wait for the owl to occur, which is when the dragon turns and the RL30 turns, then and only then enter. I don't teach this in the foundations course, but the nuances of don't trade the SQC, wait for the Z3 pinch, or better yet, a super pinch. It turns out that all of the Gen 2 stuff is fractal, and it works on swing trading and on core trading, whether you want to use weekly charts, 9-day charts, monthly charts. All of these work on those, and you got days to stock them and set them up. It's all that's good. The sniper is 5 setups of a particular type, which then use those patterns to get in. It's the setup, and then really the ruthless entry that typifies the sniper. And then if there's a whole herd of them, they keep doing kata 2s all day. On the swing trading, there's 10 or 15 years ago, we took the rule sets and we said, hey, do those work on weekly bars? Yes. We had to adjust the rules a little bit, but principle was the same. The visual box trading is just the fewest number of indicators possible. Really just price and a box. It looks a lot like the Darvis box, if you're familiar with that. But WMB3 not only works on 3-minute, it works on the swing trades. It's fractal. A couple things that I used to experiment with, the SQN divergence is in the advanced swing. Some of my best swing trades are just things that were day trade continuation trades that just kept going, and for no other reason that it was just going up and I had a position on and there was never a reason to get out, and then I just exited like a regular swing trade. So there's some of those. The difference between the RL270 and the RL10, if you express that as a number of ATRs, you can actually see a turning point, give it an ATR, and try to capture 1, 2, or 3 of those. That's all the RLF is. That also works intraday and on very long terms. That may be the laziest way to do it of all. You see any kind of observable change between the RL10 and the RL270 and cut it into 4, give it 1, aim for 3, be happy for 2, capture 1. Lather, rinse, and repeat. Any time frame, any symbol, any market. Automatic. Just get in. And what makes that one especially cool is that the R10 moves in sharp edges. The RL270 is a big, fat, lazy, smooth, rolling over. So that thing unfolds in over many bars. You see the first one, and then the trade expresses itself more or less faster. And you can take the RL90 as the intermediate leg and get two legs. And when you get to the 90 and it keeps going through, then you know you got the second leg. You had a second position there. But if it starts to fail, that's like the equivalent of the 2R battle drill. When it peaks and then starts to fail, you capture the game. Regression line fractal framework. Now, in addition to those, there's the thing that we've been teaching for over 20 years. And you'll be interested to know that the Edge Raider, who we're going into a partnership with, which has a very nice back testing feature to it. So Phil and Griff are applying and developing skills on how to back test with Edge Raider, and I had them run it on the mechanic. Every one of those things is positive expectancy, and the 5DD is out of this world good. And the simplest system of all, the channeling, has a profit factor that'll drive you nuts. And that thing has a simple rule that says there's a 200-day moving average. Price, rule number one, price greater than the 200-day moving average. 2, Williams percent R less than minus 80. So it's up and it is pulled back and you buy tomorrow's open. What's that look like? A COT of 2. So instead of just blindly buying tomorrow's open, you can actually improve that by taking that as an alert and then dropping down to an hourly chart or a 30-minute chart and fine-tune the entry. And then when that one works, it not only takes out the previous high, but it just keeps going, which is where you get the amazing profit factor. And that year in and year out has something like a 70% win rate. Guess how many symbols you can put that on? All of them. And what's best is when the S&P is in this, and then you go find the one that has, you find the mechanical swing that has the best risk reward on an individual stock or an ETF, and then the power of the S&P pushes that thing north, and you know what it can look like? It can look like Friday. When and Thursday, my brother had 51R on Thursday and had 40R on Friday. That's what happens when you stack up market, sector, and target in compound critical states. As long as you're in the game and you keep pulling the trigger, every once in a while, you not only make money, you make a lot of money. And your risk is always measured and controlled. And your positive expectancy in between the big events. You get paid to learn. I mean, goddamn, guys. Now, in the core course, we teach how to do buy and hold, how to do portfolio rebalancing periodically, whether it's annual, quarterly, monthly, every 2 weeks, or every week. If you add market timing and selection from a larger herd, you could do blended monthly rebalancing, blended quarterly. My brother's putting together the notes on how to do the sniper on 3 and 9 day or weekly and monthly, same shit. I'm playing with one to trade just in a population of REITs so that you get a large income dividend payout while you're also trading in capital gains on those things, but you can pick up some cash. Jim Carroll, who has been presenting at the Research Weekend for 15 years, teaches how to do volatility hedging. You can have him manage your money, but you got to have $2 million before he'll talk to you, because he trades in size and he doesn't have time. 15 years ago, he came to our Research Weekend, and his problem was that his volatility trading system, which was a swing trading system, was compounding at 60%, but it was leaving money on the table in the early 3 to 5 days of massive volatility events and the turning points. And could I help him learn how to trade that compound critical state better? It turns out that we can. And that's a separate system. He's going to brief on that one this year again. That was so good that it inspired Matt Richardson, who's got a PhD in, I think it's biology, and he's a corporate tax lawyer, and who came to our Research Weekends 12 years ago at Jim Carroll's recommendation, and he's now a pro money manager working with Gary Antonacci, who's kind of a legend in the field. And Matt developed the system that he uses to manage money professionally at our Research Weekends, and you can see how he did it and how he made the transition from corporate tax law into pro money manager. He's probably going to end up buying out Gary's order or customer book when Gary's getting ready to retire. But Matt's going to brief his latest idea. He has an idea of how to, when times are volatile, how to use a different portfolio that is geared towards benefiting from like income improvements. It's similar to the idea of the REIT, but he uses some different instruments. So anyway, so the core really leverages the same kind of ideas that we do for swing and day, but on a different time frame. And as you know, I do 40 and 20. This is where I make my money, and it spills into swing trades and into core trading, but this is the engine, and that's the one that's cash every night. So if I have to put a hedge on with leverage, I can get to market neutral, whatever my long positions are, I can get to market neutral with a single trade. Anyway, in the foundations course, I'm trying to just give you these. Inevitably, I end up covering those because I just think it's good for you. And I try to show that they're fractal. And this thing is fractal. And as you learn the language, you end up starting to be able to see patterns and express ideas using our common professional language. And then these things, by the way, that's still just plain rock solid. These are great signal generators because they react to what the herd, whatever the herd is doing with respect to the market, is repetitive and predictable, and those have become our mechanical swing systems. So those become excellent candidates to day trade off of what the herd is doing, which means that you got to watch SPY, a couple of the big fat sectors, and a couple of the little targets for whichever sector is working, and then apply the advanced techniques, and it improves your edge extensively. And really lather, rinse, and repeat. So, I mean, to me, I think we're about 80% of, production, and I just monkey around with stuff that I'm interested in, essentially. And also process improvement and personal performance. And I absolutely believe it's psychology in the sense of building skills and habits and disciplines and principles through actual trading. The ball is the best teacher. Let the trade teach you. Let the market teach you. So that's everything I wanted to say for today. So I'm going to go ahead and close this out. And I think, with your permission, I'd like that to be the creativity check-in, Joe, and just catch up on Tuesday. I want to go up, try to catch the rest of the football game, and go to brunch with the young lady, and feel like we covered enough for a Sunday. So, with your permission, we'll just I will bid you sayonara. This little diagram behind me is called an Enzo. It's calligraphy. It starts, you hit the paint brush, vigorous circle, and at the end of it, it kind of peters out, and there's a gate where fresh air comes in, air is exhaled, good ideas come in and out, it goes out and affects the world. It protects you against most of the things on the outside, but there's always a way in and out. And that, to me, is sort of that open-ended system but which also has boundaries where they're needed, but gates where they're needed, and a place of quiet reflection to work on. So the Enzo, you'll see that in the foundations course and in the creativity course, I think somewhere, where practicing doing that is sort of a discipline of itself to get the mindset right. Anyway, take good care, guys, and I will catch you next time I catch you. Keep sending the questions, and we shall see you on down the road.